Hello everyone and welcome to this morning's HUBsights. I'm Anne McDonald, the Head of Marketing at Hub24, and today we are fortunate to have with us James Maydew from AMP Capital and Roy Maslin from AllianceBernstein. So just a couple of housekeeping items before we kick off. The lines will remain muted throughout the presentation to prevent any background noise. So if you've got any questions for either of our presenters, please submit them through the webinar control panel, and we will hold a combined Q&A at the end of the session. So I'd just like to hand over now to James, who's going to be presenting on listed real estate and the megatrends. Thanks, James.
Thanks very much. We're going to talk for 15 to 20 minutes on a segment of the market which I find really interesting. And at the end of the day, when you think about the asset class of real estate, it really is a play on the underlying economy of the countries that you're invested in. So that's the backdrop. And what's really interesting right now is the dynamic and the change that's underway in the real estate markets because of the changes happening in the economy, this disruption that's occurring in every form of traditional economic sector. And it's no different in real estate. So as an investor in international real estate, we have the ability to be aware of those trends and to invest the portfolio accordingly for our clients. And that's what I'd like to talk to you today about. And I have 5 megatrends in the pack, but I am going to focus on probably the first 3. We'll see how we go for time. But on the second slide, you'll see 5 of the trends that we're looking at today, and there are more that sit behind this, but these are the 5 I'd like to just raise awareness of. The first, e-commerce. You'd all know a lot about what's going on there. The second, cloud computing. The third, demographics. 4th and 5th, innovation and hubs. It's quite niche, but if we have time, we'll explore those a little bit more. Okay, so turning to the first one, e-commerce. Everybody knows about Amazon. It is the most overhyped company in the world, but for very good reason. They have disrupted the retail landscape like no other company before them. But ultimately, there are winners and there are losers in the Amazon arms race. And we have the ability to invest in traditional forms of retail, be it shopping centers, malls, strip centers, high streets. And we are seeing the underlying real estate market of retail change on an annual basis. It's moving much quicker than that, but the year-on-year change is very noticeable. And the reason for that is because the demographics of the world are shifting, and millennials are now the largest cohort of the world and are going to be becoming the most important cohort for the economy in the next 5 to 10 years. And we see this setup, and we challenge ourselves to say, well, how can we benefit from this trade when it is going to be impacting the retail market? And the way you can do that is by playing the logistics market. So the likes of Amazon, any of the Chinese tech companies, they are the well-known ones, but there are many that sit behind it. And ultimately, what they're all doing is they are trying to get the best efficiency in their platform to be able to drive the economies of scale of their businesses. So that is one massive driver of demand for well-located logistics space around the world. And the trend is not going to stop in the coming years. So on the chart on page 3, you'll see the UK, which has got the most highly penetrated of all developed markets, highly penetrated internet shopping. And if you look on the light grey bar, you'll see what the current penetration rate is and what the expectation is for the next 3 years. It's going to continue to grow and take more and more market share. So demand is increasing. On page 4, we have an example of a company that we're invested in the UK. And some of the data on the right-hand side is somewhat dated because it only goes to 2012, but it gives you a similar picture to what's happening today. So I've already talked about the demand side. Let's look at the supply side. And real estate is pretty simple. It's the balance between supply and demand. So on the supply side, for certain markets in the world, we have a growing population, growing GDP growth, such as London. You want to be positioned in these logistics warehouses where you are storing the goods that are being sold through the e-commerce market. And as you can see on the supply side, it's actually been shrinking over time. And that is because historically, the highest and best use of land has not been for logistics. It's been for residential or for retail or for office. That is now changing, yes, given the landscape and the demand for e-commerce players. But ultimately, the supply of high-quality logistics facilities has been shrinking in core cities around the world. So you have massive amounts of demand coming from the e-commerce players, and you have shrinking supply globally from the existing logistics facilities. That is causing a pinch point in rents and asset values, which are seeing outsized growth in this segment of the real estate market. So we're playing that to a great degree around the world, and some of the best markets to play are LA, New Jersey, Hong Kong, and even Sydney. So the second market or change in the economy that we're looking to implement through the portfolio is in cloud computing, and this is probably where I get most excited. So bear with me if I get a little bit carried away with some of these stats, but ultimately we're all changing and accessing data differently. Some of us in this room, in fact, will be tweeting right now. But ultimately, what is going on in the world, and as millennials become a more important part of the economy, the growth that we will see, in fact, the explosion we will see in the use of data. So I personally use data through Twitter. I actually follow some of the best hedge fund minds through the FinTwit community. I use it for Netflix. I use it for WhatsApp. You know, me as a consumer, and I'm sure many people on the line can relate to that, are using different forms of platforms more intensely, which is using more and more data on a daily basis. The stat is more data is created in the last 2 years than in the history of mankind. So ask yourself, do you think that is going to change? Are your lifestyles going to change, or do you think we're going to continue to adopt the utilization of mobile technology and data more and more? If you stop and think about when the iPhone was created, the 2007, 2008 period, a 10-year-old is now the driving force of the economy going forward, and they know nothing different other than how to use an iPhone and how to buy things online. So if you can see on slide 5, the growth in data is significant. The expectations, we anticipate this to even outperform on some of these measures, and that's before we've even spoken about cloud computing. AMP as a business moved to the cloud about 7 months ago, and it's happening around the world because the realities of moving to the cloud are significant, because there are major cost savings, and it makes a great deal of sense. For a company like AMP, like many corporates around the world, the most important thing in your business is your customer and your customer's data. And if you can't manage that securely and access that in an efficient manner, then you probably don't have a business in the years to come. So the growth in data is going to be occurring both in the individual level, but also in the corporate level. But what does that all mean for us in real estate? Well, there's a new asset class called data centers, which I'm sure many of you would not have heard of because it's actually not that well known in this market, but is essentially the location of where the internet information and data is stored and accessed. We have the ability to invest in data center companies that actually own the sites, but also the infrastructure that goes on inside the sites. So we therefore get a double whammy in terms of collecting the rent, but also a fee for owning the infrastructure within that building. So if you think about it, we're owning the infrastructure of the cloud or the infrastructure of the internet. So that's probably the segment of the market I'm most excited about. On page 6, we have an example of one of the companies we're invested in. It's listed in the US. It's a pure play European data center player. It benefits from this co-location business model that I was talking about, which is essentially, if you think about two companies that want to be in a data center, let's call them Google and Facebook. Google and Facebook want to share information between each other, and they are willing to pay Interaction a fee for sharing that information. So that is a pretty amazing setup for the real estate market for data centers over the next 5 to 10 years. The next one I'd like to talk about on page 7 and 8 is actually broader than just healthcare. It's actually demographics. And I've spoken about millennials and how they're driving the economy. And that's one segment of the population, a very powerful cohort, and we've already talked about how we're playing the millennial segment. The other end of the spectrum is the aging population crisis that we have in the developed world, and it's only going to get greater over time. And on the left-hand side of page 7, there are a number of stats in and around this market, New Zealand and Australia, where you can see a huge setup for a continued growth in the aging population market. Aging population is one thing that you've got to be very cautious over because it's a very sensitive subject. Everybody wants to be looking at this market and understanding that care is the most important thing for loved ones moving into the latter stages of their lives. But the facts are the facts, and the reality is we have an aging population crisis in the developed world. It's not just this market, it's the UK, it's Germany, it's Italy, and we as real estate investors are trying to understand the imbalance between supply and demand in key markets around the world. And Australia and New Zealand is certainly one of them. So I'm talking about New Zealand right now because it's a market that's probably well overlooked. But as you can see, the age cohort of over 75 years is going to grow threefold in the next 30 years. So how do we utilize that in terms of our investment framework? There's a company called Ryman that some of you may have heard about. They've recently moved their development capability to Victoria in Australia because of the setup in the aging population in Victoria is actually better than it is in New Zealand. But the fact of a company like Ryman is they are essentially the Westfield of healthcare. They are the biggest brick buyer in New Zealand. They develop from the ground up, and their core difference is they understand what the customer wants. And as a part of that, they deliver a service which is the full continuum of care. Many aged care providers only focus on one segment of the market, such as lifestyle in the late or the early 70s, or some focus on nursing homes or dementia care, but very few actually develop and offer something which delivers a continuum of care through that entire cycle. If you stop and think about grandparents that were 85, and for them, having to move to a different location at the age of 85 is probably the most confronting thing you could ever experience. So this company, Ryman, which listed in 1999, they completely get it. The customer comes first, and the results are delivered as a consequence. They listed in 1999 with a market cap of $25 million New Zealand. They are now in the top 3 biggest companies in New Zealand, and they haven't raised a dollar of equity in that entire period. So it gives you an indication of the strength of this business. We see the setup here, as we do in other parts of the world, as being pretty significant. And the Ryman business has been able to deliver outsized earnings growth over this entire period when the demographics have been reasonably flat. When you have a 3 to 4 times fold increase in the demographics of the aging population, a company like Ryman will be able to deliver even greater outsized earnings growth while still delivering the care that is required to their customers. So that's the top 3 trends. I have got a little bit more time, so I might just talk to you about some of the other megatrends that we're focused on. One is on innovation and on life sciences. That's on slide 9. As you'll see, the cost of healthcare is a major issue around the world. Obamacare is obviously a very talked about issue in the United States, and 18% of US GDP is spent on healthcare services. That's significant, and as a global population, we are all moving to try and be healthier and try and focus on our quality and length of life. And the reality is there are 10,000 known diseases that exist in the world, and only 500 of them have been addressed to date. So there's a lot of work that goes on behind the scenes to try and address many of these challenges. So we once again see this setup. We see a lot of information around the fight against diabetes, the fight against dementia, many areas where we see continued dollar spend by tenants, and it's a growing industry. I'll talk about technology in a second, but this is one of the segments of the economy that is truly growing. So we want to be exposed to that because we believe the supply and demand is in balance when it comes to assets that are catering for these facilities. So we have invested in a company called Alexandria REIT, which is on slide 10, which is a specialist niche player in the life sciences space. So they are dedicated to providing a facility for tenants who focus on the R&D of fighting many of these diseases and challenges that we have in the healthcare system. Governments around the world, particularly in the US, are aligned to this strategy, and this company differentiate themselves by actually having a venture capital business that sits within their portfolio that actually takes a small position in some of the startup companies so they can get ahead of these trends. And the results speak for themselves. It's been the best performing US real estate company over the last 5 years by quite a significant distance. And then finally, I can't come and talk to you today without talking about one of the most iconic buildings that are in the portfolio that we're invested in, and it's linked to the technology theme. It's the Empire State Building, and it makes up a large portion of our US exposure. We were one of the early adopters of investing in the IPO as a cornerstone investor in the Empire State Realty Trust. Essentially, this company is the Empire State Building, including obviously the office, the retail, and importantly, the observation deck, which I'm sure many of you have experienced over the last 20 or 30 years. But the really interesting part is that the trends in employment are changing in New York, and it's been shifting from finance and legal services, as you'll see on slide 11, to technology. We all know tech has been growing the economy at a greater rate than any other segment of the economy. And as you'll see on slide 11, 55% growth in technology employment in New York over the past 10 years. So the owners of the Empire State Building, they have an iconic building where historically it was leased to the rag trade, paying low rents. Ever since the IPO, they've been able to get into the asset manage it aggressively, kick out some of those low-paying tenants, and redevelop the site and attract some of the most iconic technology companies in the world who are looking for an urban campus in the middle of New York City. So ultimately, the Empire State Realty Trust is one of the most interesting exposures in the portfolio. It is a play on technology and the growing importance of technology in the US real estate market. But I can't come to you and talk about the Empire State and not talk about the observation deck. And a quick stat on the observation deck. And I was there 3 years ago on Christmas Day, and there was a 5-hour queue. The reality is this is an iconic tourist destination. The real estate company understand that and have brought in people from Disney to try and maximize the revenue from that observation deck. And the observation deck revenue has grown by over 10% every year going back to 1999. And that includes growth during 2001, which is obviously the unfortunate 9/11 events. The reality is that even when people are flying airplanes into buildings in New York, the most iconic building, people still want to experience what the deck offers, which I'm sure for many of you have experienced is a wonderful thing. So I'm coming up to the end of the presentation. It's a pretty unique setup. There are many megatrends that exist in the economy, and as a real estate investor, it's our role to understand those and get as much exposure as we can at the right price in the fund at any point in time. So I'll close that and maybe for questions a bit later.
Thanks, James. Some interesting insights there on the link between trends and real estate. Thinking about the data centers as well, it would be interesting to think about how much real estate is required in China for Bitcoin miners and servers.
Totally.
All right, so next up we have Roy Maslin from AllianceBernstein, who quite timely is presenting on the upside and downside, how defence can win in Australian equities. Thanks, Roy.
Thank you. So during my presentation today, I wanted to talk about how we think about risk in equities, the challenges that creates for clients and advisors, and some strategies that we've done research on to help to protect in volatile markets. It's obviously pretty timely given the volatility we've seen in markets in the last few days. So I'll probably go through kind of the overall research, and then I'll spend some time at the end talking about what we believes happened in the last few days and how that might play out. So first of all, starting about risks in equities more broadly. Well, the great challenge in investing in equities is that many clients want to be there because of the income and potential for capital growth. However, in the short term, equity markets can fall. And if you go back since 1980, 2 out of 3 years, we've seen a peak to trough fall in the market of 10% or more. Perhaps even more important, if you take a longer time horizon and going back over 75 years, you have seen about every 5 years a much more significant correction. And if you look on the chart, the average correction in 75 years in the All Ords is close to 30%. Now, it's very hard to forecast when a correction starts and when it ends, but we can, by looking at history, understand the underlying drivers. And actually, we've seen the same 5 drivers occur again and again. And we would argue that most and potentially all 5 of these are relevant in the current environment. So historically, the most painful has been inflation. I think many might have argued in recent months that inflation is an unlikely risk in the current environment, but it's probably been one of the catalysts for the recent stock market correction. So we think that is a concern, but potentially the other 4 are even more likely in the current environment. Asset bubbles, there's been a number over time, probably go back here in Australia to the commercial real estate boom of the early 90s. Clearly around the world today, there's concerns about house prices here in Australia and more broadly technology stocks in other markets around the world. Third one is war. Unfortunately, there's a lot of geopolitical tension in the world at the moment, and again, that can be a source of stock market corrections. Fourth, technical shocks. Black Monday, October 87, that was driven by a big sell-off in equities with programmatic sales. I'll touch on this later in the current environment, but we've seen a little bit of that in the last few days. And then finally, debt crises. Again, that's an issue that can be relevant today with a lot of debt on sovereign balance sheets around the world, and obviously the Australian consumer pretty highly levered. So we think these risks are all relevant, and particularly in Australian equities, because many of these negative scenarios will be bad for our 2 largest sectors, which are banks and resources. So let's think through a little bit, what does this mean for end clients? And I want to talk through the impact of a market correction on 3 types of clients. And I'm going to go back to the last big correction we've had here in Australia, which is the global financial crisis, and talk about 3 kinds of investors. The first one is a buy and hold investor. So let's just imagine someone was unfortunate enough to invest $100,000 on the eve of the financial crisis. They had a very uncomfortable experience as they saw equity markets fall. But if they stayed invested in the index and getting index returns, then through just over 5 years later, they've got that $100,000 back. They may not enjoy the ride, but they're back where they started. But let's think about a second investor now, a retiree, also invested in the index, getting the same return as the index, but now looking to spend $10,000 per year to live on. Because they're drawing down some of their capital and markets are falling, they've got less invested when the market rallies. So invested in the same index, they're left with only $85,000 at the end of that period, including the capital and the amount that they spent. So significantly worse off despite having the same index returns. But worst of all, I would characterize as the fearful investor. We probably all know people who've seen this experience. They, again, investing $100,000 in equities on the eve of the crisis, but as markets fell, the fear and emotion just became too much. And they saw what were perceived as the much safer investments of term deposits, and they shifted into them at the market bottom. Having done that, they only have $78,000 left at the end of that period, so significantly worse off. So we think, given this example of corrections in markets, that the normal way to think about investment performance for equities around alpha may not be suitable for all clients. So I'll illustrate this on the next page, beating the benchmark. So if you're measuring success as beating the benchmark and generating alpha, you're looking to be a bit ahead of the bench all of the time. And that's really the shape on the left-hand side. But how about on the right-hand side for clients and advisors who've got a situation where their clients are particularly sensitive to downside? If we think about the world very differently, what if there's a strategy where when markets fall, you fall significantly less? But the quid pro quo is when markets rise, you may not capture all of that upside. That may be appealing for some clients. Now, the obvious challenge to this, of course, is given markets in the long run rise, if you're not capturing all of the upside, do you actually end up worse off? Well, interestingly, if you take a hypothetical portfolio all the way back since 1990, and in months the market's down, you just fall half as much. And in months the market's up, you just rise 80% as much. Over that period, you outperform by more than 3%. And that's really the benefit of smoothing the ride or defense in equity strategies. So of course that then leads to the question, what kind of approaches can be helpful if you're looking to be very sensitive to downside in equities? And our research over 15 years now points to 4 key elements. One is the kind of stocks you invest in, and I'll talk about the importance of price stability. Secondly, the kind of stocks you try and avoid, and I'm going to talk about the notion of volatility traps. Thirdly, the importance of diversification. And then fourth and finally, how you manage macro risks, and particularly relevant in the current environment, how you manage those. So if I go back to the first point, what kind of stocks do you want to invest in? So if you're really focused on downside, you think about the world differently to somebody who's just trying to generate alpha. If you're trying to generate alpha, you can do that as a value manager, a growth manager, a momentum manager. There's lots of ways to do that. But if you focus on downside, historically, there's been one kind of the style of stock that's really been the best involved in. And they have price stability. So stable businesses with stable share prices, which are low volatility or low beta, historically have fallen a lot less in the market than when it's down. So that's really how you need to anchor your strategy. I'm going to illustrate this with the next chart by showing the benefits of price stability. So if you go back over an extended period of time, on average, in a month our market's down, it falls 3%. If you just invest in stocks that have stability, technically you can call that low beta. On average, in those months the market's down, they outperform by 1.5%. So provide good downside protection. We also think, however, you need to combine that with some quality characteristics. And actually, when you do the research, there's some really counterintuitive things. So, for example, companies with low net debt to equity are often perceived as defensive, but actually companies that don't have a lot of debt often underperform. And the reason is companies that don't have a lot of debt because they're worried about the cyclical nature of their business. So you really need to understand what aspects of quality are defensive. And what's really important is not necessarily the amount of debt, but the direction. So as you can see on this chart, falling net debt is really attractive. So companies that quarter in, quarter out are paying down their debt are generally more stable. The final two factors on here are value factors. There's a big perception in this market that actually stocks that are cheap on price to earnings outperform in falling markets. In the long run, that's not true. Actually, what is important is cash is king in tough times. So actually, you want companies that aren't cheap on price to earnings. They're cheap relative to the cash flow they generate. So I want to just focus in, as I said, the core of this is stability, and illustrate this with how stocks in Australia traded in 2017. So 2017 was a big bull market, a low volatility market, and again, I'll touch on that a little bit later. But a number of our stocks, such as our miners, performed extremely well. But if you look at that on a daily basis and how stocks moved when the market was up or down, it's quite interesting. So on slide 8, we're just looking at the days the market was down in 2017. And on average, it was a pretty low volatility down. It was just under 0.5% the market was down. But our two biggest sectors, our banks and resources, on those same days were typically down more. So even though BHP had a good year, it was down more. And by the way, this is a pattern that you saw in 2016. There are other companies that have more stability characteristics that on those same days just fell a lot less. So that's the first thing we think you need to focus on, is investing in stocks that have stability characteristics. However, you can't just stop there, because a lot of companies here in Australia look strong and stable, and then something happens and they become a lot more volatile and you see their share price fall. So you also need to understand what can create that. And we actually coined the term a volatility trap, a company that looks stable that becomes more volatile. So our research going back over 15 years now has found that there are 3 causes of a volatility trap. And that's shown on the chart now up on the screen. The first of those is a cyclical downturn. And this isn't necessarily the broader economy. It's really talking about the industry that you're in. Has something changed that means that your cash flows and earnings fall, and ultimately your share price can be a lot more volatile? A really great example in recent times has been supermarkets, where we've seen price wars that has led to poor earning and cash flow outcomes for companies. The second risk is balance sheet stress. If we go back to the financial crisis, there were clearly a lot of companies that took on too much debt. You need to be really cautious when you're investing in a company where ultimately the creditors can make a call on the company. That can be through M&A or over leverage. And the third one's really interesting, and actually even more relevant in the current environment, is event risk. Many companies are exposed to government policies, regulations, and you often know an announcement's coming, but if it goes against them, it can be really negative for the outcome of that share price. A great example in recent years is how government policy and regulation has impacted our telecommunications industry. So the first 2 strategies are invest in strong, stable companies, but try and avoid volatility traps along the 3 areas that I've laid out. The third element, though, is then to think about diversification. And in Australian equities, as many of us know, it's highly concentrated in two sectors that are typically high beta and for more than the market. And as we show on slide 10, financials, even taking out REITs, a very large part of our market, and including our materials sector, are currently more than half of it. So when you're thinking about having a portfolio that's going to fall less than the market, you need to be much more diversified than our index and not invest in companies just because they're big, and diversify across a range of sectors. You can't just do it from going from the traditionally defensive sectors, because at times they can become more volatile. Now, if you look across the space here in Australia, we have some truly world-class companies. For example, in healthcare and infrastructure, we have some world-class companies, but there are sectors we don't really have a lot of exposure to. So actually, to take diversification to the next level, we think it's really attractive to invest in Australian equities, but complement it with some global stocks to help fill those gaps and improve the diversification. Now, a lot of clients are very comfortable and familiar with the big cap names in Australia, but actually, when you look over time, big has not been beautiful in Australian equities. So we've got 4 companies here that have been very large, close to 10% of our index or more, and how they've performed in the past. Telstra, Newscore, NAB and BHP. Clearly, CBA crossed that line not too long ago, and that's gone on to underperform. You don't want to invest in companies just because they're big, and as you can see on this chart, they've gone on to significantly underperform. Now, the final aspect, I think, is talking about macro risk. We've seen in recent days, but more broadly, macro themes, whether it's interest rates, whether it's currency, whether it's volatility, whether it's elections. There's a whole range of things locally and globally that can have a big impact on equities. The big problem that creates, if you're focused on the downside, is you're inherently, if you're invested in the index, taking a bet on which way one of those are going. And if you're focused on downside, that may not be what you want. So slide 12, I'll take an example of 2017, which is a really low volatility year. But you can see on this chart on the left-hand side, bond yields have been moving up and down. You can see on days that bond yields were up, on average, our market rose 0.14%. On days that bond yields were down, our market fell 0.06, not a lot. Conversely, in terms of volatility and VIX, you can see on the right-hand side, on days that VIX rose, and I'll come and talk about what's happened in the last few days in a moment, you can see our market falls, historically a lot more than that. So when you're thinking about building a portfolio, you don't want to have these embedded exposures in it. You'd ideally want portfolios that, whichever way these goes, the absolute returns are going to be attractive and you're not going to exhibit those drawdowns. So for a recap, I think a lot of clients are interested in thinking about drawdown risk, not just at an investment level and emotional level. We think reframing the debate from not just purely alpha, but strategies that do well on the downside makes sense. And I think I've laid out 4 areas here that can do it: investing in stability, avoiding volatility traps, diversification, and thinking about macro risk. I've gone through that fairly quickly because I think a lot of you are probably interested in what's happened in the last few days. So I want to talk a little bit about that and, of course, be happy to take questions. So those of you who've been watching markets, we've had 3 days of big swings in markets led by the US, 2 days of down and 1 day of up. So what do we think has been happening? So I think you've got to go to the starting point is we have had a period of extremely low volatility. And the reason that volatility matters, it's a measure of how markets thinking about risk. So when volatility goes up, that's uncertainty, it's fear, and equity markets often fall. So to put that in context, in January, if I compare the volatility in January to the last 26 years in Australia, there's almost 6,500 trading days in that 26 years. There's only been 1 day the volatility was lower than we saw in January in the 6,500. It's extremely low. And if I take the US experience, including November, December, it's the lowest volatility we have seen in that 26-year period. Extraordinarily low. So why is that? Well, we believe there's 2 reasons that volatility has been low. There's been a fundamental reason and there's been a technical reason. The fundamental reason is actually the world has generally had positive macro signals. Global synchronized growth, the world's getting better. We're eventually getting out some of the challenges of the financial crisis. It's made markets more optimistic and reduced volatility. On the technical side, though, locally and more important globally, all around the world, we believe there are a lot of different trading strategies with a range of different names, CTAs, vol capping, risk parity, all these different names, which are ultimately depressing volatility and are winning when volatility is low. So what's happened? So at the end of last week, there was some macro data that was slightly positive, and it actually started some concern about inflation, but we don't think the overall fundamental view changed that much. What we think really happened was much more of a technical nature. The market is artificially depressing volatility, and as we saw a little bit of a drawdown in equities, there are a lot of rules-based strategies around the world which are just forced to sell. They're very programmatic and they're forced to sell. And if you look what happened on the Dow, over a few minutes, it fell dramatically as these rules came in and pushed markets down. So where do we go from here? Well, we've seen Australian equities, at least in the short term, recover some of those losses. So let's think about what's happened in the past here. So I think looking at 2015 is an interesting example. But just to today, the way I would describe the overall view from here is it's a little bit like you've had an earthquake tremor. And if anybody's unfortunate to live in an earthquake zone, whenever you have one of those tremors, the big question is it over? Or is this the first tremor and the big shock's coming? And the honest answer is at this stage, we don't know. What we have seen is that people have stepped up and buy on those dips and stood in the way of that programmatic selling. And I think what's happened is that a lot of people on the cash on the sidelines have been buying those dips. But market sentiment is now more fragile. So if we take another hit, it is more likely we could have a downturn. So I compare that to what happened in August 2015. It's the last time volatility spiked. And if you may remember, that was when we had all these tensions about the Greeks were going to default. Volatility spiked up. Our market fell 7% that month and went on to full 10. Interestingly, the deal was done to save Greece that month. So the macro issue ran away, but we saw continued selling from a whole range of programmatic trades that pushed markets down. What then hurt us in that period is when we had concerns about China and the markets took another step down. And peak to trough over that period, markets fell more than 20%. So I think the situation we're in today, in the very short term, we've seen people step up to buy the market, but now the market's more fragile. And if we have another kind of macro shock, I think that's going to more likely tip the market over. I think I'm probably coming up to my 20 minutes now, so I might wrap up as well and look forward to the questions that we may have.
All right, thanks very much, Roy. So we've just got a couple of questions here, starting off for James. How will the real estate sector perform versus general equities during a sell-off?
So Roy's charts would have shown that real estate historically is less volatile than the broader equities generally, with the exception of the financial crisis. And real estate was very much at the center of the challenges during the financial crisis with too much leverage. But ultimately, real estate is lower beta. It is lower risk, and it's somewhere between a bond and an equity is how you could describe it. So if we see a significant derate in the equities market as a consequence of lack of confidence because of equity market valuations, then real estate will hold up reasonably well. If, however, we see a continued spike in the 10-year because inflationary expectations continue to be of a concern and elevated, then there's no clear-cut reason to say that the real estate market would then outperform equities. So it all depends on the reason for the sell-off.
Okay, thank you. And Roy, you mentioned a little bit about volatility currently in the Australian market. The question is, where do you currently see risks and opportunities in Australian equities?
Yeah, so we've done a lot of scenario testing as to how the market might fall or correct, and I've touched on some of that in the presentation. Many of those are negative for our two largest sectors, banks and resources, and we actually see a number of risks in those. They're actually higher beta than normally and actually falling more than normal when the market's down. So compared to our index, we own a lot less resources and a lot less banks. Where do we see opportunity? It's important to be diversified in stable businesses. We see that across a range of sectors. So we see healthcare, where there's a number of world-class Australian companies. We see areas we like in infrastructure, in packaging, in gold, and some consumer areas.
Right. So healthcare is a popular theme today. And another one here for you, James. What is your view on major regional markets globally for office, retail, and industrial?
Sure. So I've talked about industrial already. I think it's a global secular trend that as long as you have strong demographics, strong population growth, and you're aligned with economies that are moving in the right direction, I believe logistics is a pretty good setup for the industrial market. Retail, it really does differ. You need to be invested in core markets around the world which have the similar setup to what I mentioned with logistics. But if you're not delivering an experience in your shopping environment, I really do think you're going to be challenged somewhat going forward. So our preference is to own in the core major cities of the world. So San Francisco, New York, London, Paris, they're our core areas of focus. In those areas that are, let's call them backwaters of the world, in regional locations, relative to those core markets, our preference is to not be invested there because we do feel they will be severely disrupted by the growth of e-commerce. And then office, it really does differ from region to region. Singapore has had a poor office market now for a number of years as a consequence of too much supply and a stagnant GDP growth. That to us is now just changing. So we're very excited about the setup in the Singapore office market because we believe it's in a cyclical starting trajectory, which is very exciting. Same goes for Berlin or the general office markets of Germany. The same goes for Spain, and the same actually goes for Sydney. But you look at the US, some of the office markets that we're less excited are actually, I've talked about New York being fantastic, but there are segments of the New York market which you want less exposure to. The big shiny office buildings that have traditionally been in Midtown, that to us is not where you want to be invested because that's not where you're seeing the growth, the jobs growth. So it all depends really on where you're seeing the white collar employment.
Okay, and for you, Roy, how do you recommend putting these defensive equity strategies into practice?
Yeah, so I think many people who are focused on downside, retirees, people transitioning to retirement, or actually savers more broadly, they want simple, transparent strategies. So we'd recommend it. It should be simple, transparent, long only. We think that should avoid the cost and complexity of derivatives. That's consistent with that simple, transparent approach. And in terms of diversification, investing perhaps 80% in ASX-listed companies, but enabling yourself to invest 20% in non-ASX listed or global stocks really helps significantly improve that diversification and improve the downside protection of the investment strategy.
Okay, that wraps us up for today. Thank you very much to both James and Roy for joining us today, and keep an eye out for our upcoming HUBsights webinars for the rest of February and March. Thank you very much.